You know that feeling when you're grinding at work, constantly thinking about money, but you're absolutely exhausted. Your relationships are suffering, you're checking your portfolio obsessively every single day. And if you stop for even a second, you feel like everything falls apart. Sound familiar? Well, what if building real wealth doesn't actually require destroying your mental health and social life? Most people think financial independence is brutal suffering for decades, but the people who actually build serious wealth without burning out figure out how to make the process automatic and sustainable. My name is Nick, and I spend way too much time thinking about money, personal finance, and why some people seem to effortlessly build wealth while others burn themselves out chasing quick wins and then give up entirely. If you're tired of the feast or famine cycle, the emotional roller coaster, and you actually want to understand how to build wealth while maintaining a life that's worth living, make sure to hit that subscribe button and give this video a thumbs up if it helps shift your perspective on what's actually possible. Before we dive into the systems that actually work, let me ask you something. When you think about rich people, what comes to mind? Maybe you picture someone working 80-hour weeks, grinding away at a startup, completely obsessed with making money at the expense of everything else. Or maybe you imagine someone who inherited wealth, got lucky with a business deal, or made some brilliant investment that went to the moon. And yeah, some wealthy people do fit those descriptions. But here's what most people don't realize. The people who build generational wealth, who reach actual financial independence without sacrificing their sanity in the process, they're not grinding harder than everyone else. They're actually working smarter. They figured out a way to automate their wealth building so it happens in the background while they're living their actual life. And that's the entire game right there. It's not about finding the fastest path to $1 million. It's about building a sustainable system that generates wealth consistently without requiring constant attention and mental energy from you. Let's talk about something that most financial advice completely gets wrong. There's this idea that to build wealth, you have to operate from a scarcity mindset. You have to be obsessed with saving every single dollar. You have to say no to everything fun. You have to treat money like it's this rare, precious resource that disappears the moment you spend it. And yeah, avoiding wasteful spending is important. But operating purely from scarcity burns you out. When you're constantly restricting yourself, eventually you break and blow your savings on something stupid. The people who build wealth sustainably shift from a scarcity mindset to an abundance mindset. Instead of asking, how can I save one more dollar? They ask, how can I earn one more dollar? Instead of obsessing over expenses, they focus on building assets that generate income. That shift changes the entire emotional experience. You go from feeling deprived to feeling like you're building something that works for you. Now, I'm not saying ignore your spending, but the path to real wealth isn't just cutting expenses. It's about creating systems that generate income while you focus on things that matter. Successful wealth builders understand you can't randomly save and hope it works. You need clarity about what you're building. That starts with setting realistic financial goals. The difference between someone who builds wealth and someone who stays broke is usually that one has clear targets and the other doesn't. So decide, what does financial independence look like? Maybe retire at 50, maybe have 6 months of expenses saved, maybe own rental properties generating passive income. Whatever it is, you need to know specifically what you're working toward. Then work backwards. If you want to retire at 50, how much do you need saved? Once you have these numbers, your savings goal becomes concrete instead of vague. You go from playing defense with your finances to playing offense with a strategy. And once you have a clear goal, you can start building a budget that actually gets you there. Now, budgeting gets this terrible reputation because people think it means tracking every single dollar and never having fun. But a budget is just a spending plan. It's telling your money where to go instead of wondering where it went. And here's what most people don't understand about budgeting. It's not restrictive if you do it right. it's actually liberating. Like when you know exactly what you're spending on rent, groceries, transportation, entertainment, and savings, you're not constantly wondering if you can afford something. You already know. And the psychological freedom that comes from that is massive. You can actually relax because you're not operating in a constant state of financial anxiety. But here's where most people mess this up. They create a budget, follow it perfectly for 2 months, then get tired of tracking everything and abandon it completely. And the reason that happens is because they're trying to do it all manually. They're trying to willpower themselves through their financial plan every single day. And willpower is finite. You have a limited amount of it, and you're probably using it up on a million other things. So here's the game-changing insight. You don't need willpower, you need automation. Think about this for a second. What if your wealth building happened completely automatically? What if the moment your paycheck hit your account, money flowed to the right places without you having to think about it or do anything at all? You'd never see it. You'd never have the opportunity to spend it. And you'd be building wealth without the constant mental battle. This is the secret that separates people who actually build wealth from people who talk about building wealth. Automation removes the decision fatigue and the emotional component. It turns good intentions into reliable actions. When your savings and investments happen automatically, you're not fighting yourself every month. You're not questioning whether you should save or spend. The system is already running. You set it up once, and then it just works in the background while you live your life. The beauty of this is that you're not depriving yourself at all. Most people think automation means you have to live like a monk. But here's the secret. If you automate your savings before you see the money, you don't feel deprived because you never had access to it in the first place. You simply adjust your lifestyle to what you have after your savings have been automatically removed, and suddenly wealth building becomes effortless instead of this constant mental struggle. Let me paint you a practical picture of how this works. Let's say you make $75,000 a year. That's about $2,300 every 2 weeks after tax. You set up your automation to immediately transfer $400 to savings, $300 to retirement accounts, and $200 to investments. That happens instantly without you ever seeing it. You're left with about $100 to $400 every 2 weeks to cover your actual living expenses. And here's the crazy part. Most people can live a completely normal, comfortable life on that amount. You can still go out with friends. You can still enjoy hobbies. You can still have fun. But now you're building wealth automatically in the background. After 1 year, you've accumulated $2,400 in savings plus $13,000 in investments without having to willpower yourself once. After 5 years, you've got nearly $52,000 sitting in savings plus around $75,000 in investments, assuming some basic returns. And you did this while maintaining a totally normal life. No sacrifice required, no burnout, just a system that works while you focus on the things that actually matter to you. Now, before you start talking about investing and trying to pick the next hot stock or cryptocurrency that's going to make you rich, you need to build an emergency fund first. I know this sounds boring. I know you'd rather jump straight to investing and watching your money grow. But here's why this matters more than you think. An emergency fund isn't just about having money for when something unexpected happens. It's about creating a psychological safety net that prevents you from making terrible financial decisions when life inevitably throws you a curveball. When your car breaks down or you face an unexpected medical bill, and you don't have an emergency fund, what happens? You either sell your investments at the worst possible time, locking in losses, or you go into high-interest debt. And high-interest debt is like pouring sand into your wealth-building machine. It gums everything up. Research shows that people with at least $2,000 in emergency savings have financial well-being scores that are 21% higher than those without any emergency fund. That's the single biggest boost linked to any financial factor. So start by getting your first $1,000 saved as quickly as possible. That covers most minor emergencies, then work toward 3 months of living expenses. This creates a true financial safety net. And here's the beautiful part. Once you have this buffer, you stop making panicked financial decisions. You stop liquidating investments when you panic. You stop going into debt for every little surprise. You can actually sleep at night without constant financial anxiety. Once you have your emergency fund in place, now we get to talk about something that most people get completely wrong, which is how to actually grow your money. They think it's about picking the right individual stocks or finding some secret investment strategy that only the wealthy people know about. But here's the reality. The secret to building wealth through investing is understanding compound interest and starting as early as possible. Compound interest is when your money earns returns, and then those returns earn their own returns, and then those new returns earn returns. It's like a snowball rolling down a mountain, picking up more snow as it goes. The longer that snowball rolls, the bigger it becomes, and this is where time becomes your biggest asset. Let me give you a practical example. Imagine you're 25 years old and you decide to invest $10,000 and then never add to it again. Just let it sit there earning 7% annually. By the time you're 55, that single $10,000 investment has grown to almost $77,000. You didn't add a dime. You just let time and compound interest do the work. Now compare that to someone who waits until they're 35 to invest that same $10,000. By age 55, it's only worth about $40,000. That single 10-year delay costs them roughly $37,000. Time is literally free money when you're investing, and the earlier you start, the more powerful this becomes. Now here's where it gets really interesting. Most people think they need to pick individual winning stocks to beat the market, but study after study shows that over long periods, the vast majority of active traders underperform simple index fund investing. You know what beats almost all professional stock pickers? Just buying a diversified fund that tracks the entire market and holding it for decades while the magic of compound interest does its thing. It's boring, it's unsexy, but it works, and more importantly, it doesn't require constant attention. You're not checking your portfolio every day. You're not trying to time the market. You're just letting your money sit there and grow while you live your life. Now, let's talk about something that wealthy people understand that most people don't. Passive income. This is the key to building wealth without burning out, because passive income is money that shows up without you having to actively work for it every single day. The wealthiest people in the world aren't trading time for money. They're letting their assets work for them. And here's the thing that's accessible to basically everyone: dividend stocks. This is one of the simplest ways to start generating passive income, and it requires almost no ongoing effort. When you own stocks, especially stocks from companies like Johnson & Johnson or Coca-Cola that have a history of paying dividends, you receive a portion of the company's profits every quarter. Let's say you invest $10,000 in quality dividend stocks earning an average yield of 3%. That's $300 per year flowing into your account without you lifting a finger. Now, here's where compound interest kicks in again. If you reinvest those dividends automatically, you're buying more shares, which generates more dividends. That $300 dividend in year one becomes $309 in year two. Sounds tiny, right? But over 20 years, that initial $10,000 could grow to around $18,000 just from this passive income stream. And you're not doing anything. You're not checking markets constantly. You're not making trades. You're not stressing about anything. You just set it up and let it run. This is what real wealth building looks like. It's not exciting. There are no get rich quick stories, but it works. And more importantly, it doesn't destroy your mental health in the process. Another passive income strategy that a lot of people consider is real estate. Now, I'm not telling everyone to go out and buy rental properties tomorrow because that requires capital and comes with its own set of challenges. But rental properties can generate solid monthly income, and they also appreciate over time. You're essentially building wealth through someone else paying off your mortgage while your asset grows. The key is finding properties in good areas with reasonable rents. And the best part is that once you've bought the property and set up a property manager, the income generation becomes passive. You're not actively working for that money every month. You're just holding an asset that produces cash flow. Of course, you have to maintain the property and deal with tenants and all that stuff, but compared to actively working a job, it's a much more passive approach to generating income. Here's something that most wealth builders understand, but most people miss: diversification. This isn't boring finance advice. This is actually critical to your wealth building not blowing up. When you diversify, you're spreading your investments across different asset classes, some stocks, some bonds, maybe some real estate, maybe some commodities. This does a few things. First, it reduces your risk because if one asset class tanks, your entire portfolio doesn't go with it. Second, it can actually increase your overall returns because different assets perform well at different times. When stocks are down, bonds might be up. When inflation is rising, commodities tend to do well. By holding a mix of these, you're protecting yourself while still capturing growth. The allocation depends on your age, your risk tolerance, and how long until you need the money. Someone in their 20s might be 80% stocks because they have 40 years for the market to recover from downturns. Someone in their 60s might be 40% stocks and 50% bonds because they need stability and income. There's no one right answer, but the principle is the same. Spread your bets. Don't put everything in one place. This approach might feel slower than going all in on the hottest stock, but slow and steady actually wins this race. And the emotional stability that comes from knowing your portfolio is diversified is worth a lot. You're not panicking every time one sector drops 20% because you know it's only part of your overall picture. Now let's talk about something that most people completely underestimate when it comes to building wealth without burnout. That's debt. Specifically high interest debt like credit cards. Here's the math that should scare you straight. If you're carrying a $5,000 credit card balance at 22% interest and you're only making minimum payments, you'll pay nearly $2,800 in interest alone over 5 years. That's money that could have been working for you. Instead, it's making credit card companies rich. High interest debt is toxic because it's a guaranteed loss. You're guaranteed to lose money paying that interest, and that guaranteed loss is almost always higher than any reasonable investment return you could make. So here's the rule. Before you start getting fancy with investments, eliminate high interest debt. Use something called the debt avalanche method, where you list all your debts with their interest rates, pay minimums on everything, and throw every extra dollar at the debt with the highest interest rate. This saves you the most money mathematically and gets you out of debt faster. Once that's gone, the next dollar you would have sent to interest can instead go into building wealth. And the psychological impact of being debt-free is huge. You're no longer sending money to your past. You're building your future. That shift alone can reignite your motivation to keep building wealth sustainably. Here's something most people don't think about when they're building a long-term wealth strategy, but it becomes increasingly important as your money grows. Taxes. Sounds boring, right? But here's the thing. You can minimize taxes through smart strategy. The biggest one is maxing out tax-advantaged accounts first. A 401k lets you reduce your taxable income while your money grows tax-free. An IRA does the same thing with a contribution limit of $7,000 per year. A health savings account is like the Swiss Army knife of tax advantages. You get a tax deduction for putting money in, it grows tax-free, and withdrawals for medical expenses are completely tax-free. That's 3 layers of tax advantages in one account. When you maximize these accounts, you're essentially letting more of your money compound without the government taking a piece every year. That compounds over time into serious money. Someone who contributes $35,000 per year to tax-advantaged accounts for 30 years will end up with vastly more wealth than someone who puts that money in taxable accounts paying taxes on gains every year. It's the same amount of work, the same amount of investment, just smarter structure. And tax loss harvesting, which is using investment losses to offset gains, can save you even more money. The point is that as your wealth grows, paying attention to tax optimization isn't boring accountant stuff. It's leaving money on the table if you don't do it. So Here's where we land. The building wealth without sacrificing your life isn't about working harder than everyone else. It's not about grinding yourself into exhaustion. It's not about feeling deprived and miserable. It's about building systems that work automatically while you focus on the things that actually matter. You set up your automation so money flows to savings and investments without you thinking about it. You build an emergency fund so unexpected events don't derail your progress. You let compound interest do the heavy lifting over decades. You generate passive income through dividends and assets that work for you. You diversify so you're protected against catastrophic loss. You eliminate high interest debt so it's not eating your lunch every month, and you optimize your taxes so more of your money keeps compounding. That's it. That's the entire strategy. Nothing flashy, nothing risky, nothing that requires you to destroy your mental health or sacrifice your relationships. Just consistent, boring, systematic wealth building that actually works. The people who do this end up financially independent, not because they got lucky or inherited money or made some brilliant investment call, but because they understood that wealth building is a marathon, not a sprint. And the only way to finish a marathon is to pace yourself sustainably, which means automation, which means systems, which means letting your money do the work while you live your actual life. That's real wealth. And that's worth far more than a fancy car or expensive house or whatever else society tells you that you're supposed to want. Build your systems, automate your wealth building, then just focus on living. Your future self will thank you for having the discipline to do this the right way. The right